Hey, I'm Robert with Mountain America's Financial Education Team, and I'm excited to spend a little bit of time with you today to help you better understand some investment basics. Chances are if you're watching this video, you've probably got a lot of time ahead of you that you can begin investing, whether it be for retirement or for other goals. The great thing about investing is with technology, it's not just for retirement anymore, and that's what we're going to get into. Make sure that you understand the basic elements of investing so you can feel comfortable making it a part of your overall financial plan. But to start out with, we actually want to put formal investing aside and make sure that we can create a context for investing. Investing is an up and down experience. The markets go up and down. It looks like and it feels like you've lost money when maybe you haven't. And so to help manage the experience, one of the best things that you can do is to make sure that you have connected your investing behaviors, your investment goals, to something that's meaningful to you. There's a reason behind your investing. You've got values in place. Maybe you want to put a larger down payment on a home, but you know that's 7 to 10 years away, so you've got time for investing to be safer. And so it's connected to that. It keeps you in the market despite the ups and downs. It's connected to what's meaningful. That helps in those emotional situations make sure that you don't sell when you shouldn't, or you don't get too excited and buy more when you shouldn't, but you keep on your track. We call this goal-weighted returns. You're measuring the percentage that you need in investing in the markets and the risk that you're willing to take based on the goal accomplishment and not just the idea that we sometimes get excited about of making money in the markets. That's where we have to start. Once you've got that in place, then we need to start to understand some of the basic investing tools. It can be really confusing with terms like 401k or IRA, stocks, bonds, funds, cash equivalents. What does it all mean? Accounts are different than investing instruments. Chances are you've heard of 401k or IRA and you think that that's what you're investing in. That's not. Sometimes it's helpful to think of it as a parking lot. The account, like the IRA or the 401k, is like the large parking lot. You parked in parking lot 401k. And the spaces are where you're actually putting your money, putting your car. That could be a stock or a bond. And so when you're thinking about investing, start with that understanding. IRAs, 401ks, brokerage accounts, that's the place where the money is, and that determines how it's treated by tax. If you can't take it out until 59 and a half, it's usually a retirement-focused account like an IRA or a 401k. A brokerage account allows you to move it in and out a little bit more freely, and it's treated and taxed like income with capital gains rates depending on how long it's been in there. So knowing your context, knowing the account your investments are going into, it's also important to know what you're investing in. Is it a stock or is it a bond or is it a fund? It can be helpful to think of the different instruments in another analogy. Gumballs and gumball machines. The machine itself is the account that we were just talking about. And inside of there are the different instruments like stocks or bonds or funds. A stock is a part of one individual company. It's like buying one color of gumball. You own something and you hold it and it's valued until you sell it. You've got that asset. But that's what a stock is. It's one color. A fund is made up of multiple companies within one investment. And so it's like having many colors all together. Historically speaking, those are the ones that are a little safer and produce a little bit more predictable return. Once you've bought the stock or the bond or the fund within your account, now you also need to measure your risk and understand the effects of volatility. They're not always the same. Risk is determined by when you need to withdraw the money. If it's not until retirement, you've got a long time for those ups and downs to just keep going up and up and up over time. And to capitalize off of that, when the market goes down and you keep buying stocks, it's like you're buying on sale. The price has decreased, you can buy more for the same amount, and your growth accelerates. That up and down is called volatility. If you need the money at a down time in the market, now we're starting to experience risk. That's what's determined by time. Time changes volatility into risk. So understanding the account that you've got the investment in, the instruments you've invested in, and the time that you need the money is how you determine whether or not a particular investment is right for you. If you're investing for a larger down payment on a home, You can take a look at something like a brokerage account and determine what's the number that I want to get to, how much am I willing to put in, and what return do I need. If you're looking to start getting investing, technology can help you with all of that. If you can download an app like Betterment, Acorns, Robinhood, Stash, some of these things that you've heard about before, those are called robo-investors. They'll ask you those exact same questions. What do you want? When do you want it? What are you willing to do to get it? How much are you willing to put in? And they can suggest what it is that would be best for you to invest in. So, those are some investing basics. That can get you started. Knowing your context, knowing the account, choosing your investments, being guided a little bit by technology, and you can start with a penny or a dollar with some of those apps. If you want to learn a little bit more, go to macu.com. We'd love to help make sure that you feel comfortable using investing as a great tool to accomplish your financial goals.